One of the biggest reasons that, of course, you listed on the JSE is because of your new strategy, Cielo Blue, and of course it's really got to do with distribution within the industry. We know that you raised around 575 million rand. Tell us about the targets that you put in place. Are you on target? Are you in budget at this point?
Yes, the whole intention of the listing was to raise money for Cielo Blue, which we did, and it was a challenging year in the sense that we had a listing, we had the restructuring of the capital, we had Project Reset that we had to implement, which was the lowering of the prices to make us more competitive. And then obviously the big talking point is Project Cielo Blue. Now that aim of Project Cielo Blue is twofold. The one is to create additional capacity, which we ran out of. But more than that is to reposition our factories, which are currently in the market and not in the source, to reposition that back to that.
And that's moving to the Cape, essentially?
That is moving to the Eastern Cape and Natal. So as we stand today, the project has been implemented. We're still within the target. We're still in the timeline, and as well as in the budgeted process. So that's been very excited for us, because that all aims to bring down the price to the consumer.
You mentioned bringing prices down and, of course, cutting prices. One of the reasons that you were able to do this quite aggressively over the period, we know that 540 people were retrenched. It basically cost the company 150 million rand or so. That was experienced, and we felt the pressure there in the previous financial results. But you're seeing a cost saving per annum of 120 million rand, and this you've passed on to the consumer. Over and above that, what other price cuts have you passed on?
Yeah, that money that we put back into the price has led to us for the last 3 years being able to increase our market share. And with Cielo Blue, that's going to create extra capacities. We need to make sure that we have that momentum of additional market share so that we can put that quantities through our infrastructure. But we are continuously trying to reduce the costs. I've often said in my annual reports that the supply chain cost is too expensive in this country. So our aim is to continuously broaden that base, because dairy must become accessible to the broader South African population.
Well, you're talking about the supply chain costs. We know that input costs are very high, especially for the producer. You are the processor, and then you have the retailer at the end. And just looking at the overall cycle that we're looking at this point, we know that there has been a lot of issues that have come from the producer's end and the margins that they're experiencing. You've got a margin of 6.1%. Can you get this higher, or is this as good as you can go?
So that's the EBITDA is 6.1%. On an EBIT basis, we had 5%. Internationally, that's a good benchmark, between 3 and 6%. But we are very well aware that there are cost pressures on farm. We monitor it constantly. Fortunately, we've been able to increase the volumes, and volume is a very good counteract against inflationary pressure. So we have handed out quota, 50 million more litres of quota to our producers, which will help through this high season period. But we're very well aware that if these cost inputs persist, that there will be a milk price increase coming autumn.
And does that affect the demand? Do you notice a significant impact on the demand?
Well, first of all, it will be for the whole industry, so all the prices will have to go up because all the farmers will be in a similar position. But hopefully that will not influence the consumption as much. Currently, we're sitting with the consumers being a little bit under pressure after the strikes, but we're starting to see that the effect of the wage increases and so on coming through. So hopefully from October things will normalise.
Okay, we're also just looking at your supply agreements. We know that 75% of it is basically set in stone, and you have a buffer of around 25% or so. Tell us about the capacity utilisation within the supply agreements at this point.
We have issued, as I said, 50 million on top of 650 million additional capacity, which is quite substantial. So our market share have grown considerably. But we have full access to capacities in terms of our milk production, except for in Ekopa we need to spend 22 million on a new milk depot. So that's the only constraint that we currently have. On the sales side, however, we know that Cielo Blue will address those capacity constraints on the secondary distribution side.
Also touching on the rest of the African continent, because we know you're starting to spread your tentacles within Africa as well, and I'm sure it must be a tough task because it's all about infrastructure spend as well. What kind of headway have you made within sub-Saharan Africa at this point?
We've made it clear that South Africa is our priority. Our desks are clean. We want to implement Cielo Blue first. But however, in West Africa, Nigeria specifically, we have a launch project there, which we figured a pilot study to figure out exactly that, because you're 100% right, it's all about infrastructure. There is none infrastructure. So as our partners like Shoprite and so on expanding into Africa, that also helps us with the route to market going in there. So a very small scale currently. Once we know what the business model should look like, we should then roll it. We will then roll it out.
Walmart, of course, in South Africa officially. There has been concern with regard to certain products, and we know that powder milk and in fact long life milk could be an issue. What kind of scenario are you foreseeing? Are you pricing in a threat, a particular threat within that field?
No, we don't think so. If you look at where the cost of the product lies, It's not on the farm, it's not in the final product or the packaging. It's in the supply chain. And Walmart has been very aggressive in the supply chain internationally. And we think that they will create a bit of a wake-up call to our supply chain partners in terms of how to get the product economically and viably to the end consumer. So we're looking forward to the entrant in the market.
Okay, for more competition. All right, you're talking about passing on cost savings to the consumer, which is fantastic news because this is how you've actually maintained and gained market share in certain instances. Can you maintain these lower prices? Is it something that you can maintain on a sustainable basis?
We think that we have reset to a point now where we can't go any further if we do not have implemented Cielo Blue. So Cielo Blue will give us that further impetus, but that's 18 months out. So we're now back to where we must pass on inflationary pressures to the consumer, unfortunately.
Dairy, of course, and the dairy industry is a very tough industry at this stage, because there are so many headwinds that you could face and challenges, and as you mentioned, the further you go up the chain, the safer it becomes. What is the biggest challenge for you right now that you're facing?
Well, remember, we exited bulk commodity markets, the bulk cheese and the powder, so we in commodities, in brands currently and out of commodities, and a brand is a little bit more resilient against these sort of headwinds, as you mentioned it. The biggest challenge we think is input costs, specifically on-farm input costs.